Hello! Today I'm going to be creating a balance sheet. So we're working with the same information as we were the previous two videos where we created the income statement and the statement of retained earnings. So the first thing I want to do is review what we call the accounting equation. The accounting equation is assets are equal to liabilities plus equity. So this always must hold true for any company. The total of all assets must equal the liabilities plus equity. And why is that important? Well, it's because the balance sheet shows the details of the accounting equation at a particular point in time. So the balance sheet is going to show us exactly what our assets, liability, and equity look like as of March 31st. Alright, so now getting to the statement. The first line is going to be the name of the company, which is Schumann Consulting. The second line is going to be the name of the statement, which is the balance sheet. And the third line is going to be the date, which is as of March 31st. Now note the date is a little bit different than it was in the income statement or statement of retained earnings. For the balance sheet, this is at a particular point in time, meaning what's our accounting equation look like as of March 31st. That's a little different than, say, the income statement, which is measuring income for a period of time, say the entire month of March. So make sure you don't get those two things confused. Alright, now moving on to the first part of the accounting equation, which is our assets. So I'm going to highlight this in yellow, just so when we get to the accounts over here, I can easily show where they're coming from. So assets, if you remember, are something that you own or control that's of material value to the company. So maybe pause the video real quick and see if you can determine which of these accounts over here are assets. Alright, so assuming you gave that a shot here, going through the assets, first we have cash. So I'm going to highlight that. That's definitely something that the company owns or controls. We've also got equipment right here. We've got the accounts receivable. Now that one might be a little bit more tricky if you're not familiar with it. That refers to money that other people or other companies owe you. So you have a claim to that cash, so therefore we're going to consider that an asset. And we've got land right here, definitely something you own or control. And we've also got supplies. Now there is a particular order that we want to list these assets on the balance sheet. We want to order them in what we call liquidity order, meaning how close is the item to cash, or how quickly is the item going to be used. So you're always going to want to list the cash first. So let's go ahead and put that there. And the next closest thing to cash, or the closest to be used up, is going to be accounts receivable. So those are typically going to be used, or collected, I should say, within a month, maybe 2 months. So that's going to be pretty close to cash in liquidity order. Next thing would probably be the supplies. Those are usually used up fairly quickly. Next one would be the equipment. Usually that stays around for a little bit longer. And then finally the land, which is pretty permanent for the most part, unless you're relocating. Alright, so now that we have all these assets down here, we can go ahead and total those up. So total assets, we can add those together. If you had a calculator, you just add them in a calculator, but since I'm in Excel, I can use the sum function. And we find that the total assets are $134,000. Alright, we can move on to the right-hand side of the accounting equation. And just as the accounting equation has left and the right-hand side, oftentimes you'll see in the balance sheets, at least with the simpler version, that the assets go on the left-hand side and the liabilities and equity will go on the right-hand side. So let's put our liabilities here. So we usually think of liabilities as something that the company owes someone else. And usually the key words here are either payables or unearned accounts. So let's highlight this in green here. And it actually turns out in this particular problem, there's only one account that's either a payable or unearned account, and that's accounts payable right here. So I'm going to highlight the accounts payable, and that's for $21,000. That's kind of the other side of the accounts receivable. So this is money that we owe other people, $21,000 worth. So that's going to be a liability for us. And since that's the only liability, we don't need an extra line for the total. We can move right on to equity. So let's put that in blue. And at this stage, there's usually only two equity accounts that you're going to want to think about. And that's going to be common stock, which is right here, for $106,000. And the other one is going to be retained earnings. Now you'll note that there actually is no retained earnings account on this sheet over here in the information. That was because this was a new company, so we didn't list a beginning retained earnings account. And even if there was a retained earnings here, that would refer to the beginning balance, and we're actually looking for the ending balance. So the correct location to find the retained earnings for the balance sheet is actually going to be the statement of retained earnings. So I'll go back to there really quick. The statement of retained earnings shows that the retained earnings as of March 31st is $7,000. So we come back here, we can put the retained earnings on here for $7,000. All right, now that we have all of our equity, we can total that up. So that's 106,000 plus 7,000. That's 113,000. And then finally, we can total up the liabilities and the equity together. So we have a line total liabilities and equity. And that's going to be 113,000 plus 21,000. That's $134,000. So this is good news because our assets do match our liabilities and equity. That means that the accounting equation has been satisfied. So in conclusion here, for the balance sheet, you're always going to want to list out the assets, the liabilities, and the equity accounts. And hopefully at the end of the day, your total assets match your total liabilities and equity. And if they do, that's good news. That means you've most likely completed the balance sheet correctly.